Hi, good morning, everybody. We'll just wait for a couple of more minutes for more participants to join in, and then we'll start. We'll start at about 11:10. Hi, good morning, everybody. I think I've been given the go ahead to start. I think I'm having some issue with my camera, uh, so please do bear with me. But other than that, is the presentation visible? If somebody can just give me a yes or a thumbs up, and then I'll just start. Yeah, then it's perfect. Okay. So today we have another interesting topic. It's high risk and high growth. It is another it is a part of the strategy series. And what we are going to do is we're just going to explore where is it that investors have sort of gone out and taken risk, right? And how has that particular journey been? And can this be sustainable going forward, right? And then we'll look at where we can take risk. Uh, in fact, in the last webinar also, when there were I think the last one was the election webinar, where I was talking about a risk on approach and where is it that we have to take that sort of risk on approach, and I had dwelled into some ideas there. So milestones to wealth, uh, again, is a behavior oriented program, but since it is part of this, this is again a part of a knowledge series that you can use. It's just so that you get the right information, so that you can use it extremely well, right? But these are ideas that we've covered in the past, so it is a good refresher. At the same time, you are getting this sort of awareness as to what has happened, and where is it that you should be, and what is the sort of direction that you should be taking right now, right? So again, like always, I always start off two slides, because it's very, very important for everybody to understand how do market cycles work, and what is it that investors should do in a market cycle, right? So every market cycle works uh, with- in two emotions. One is greed and the other is fear. Every time there is excess fear, you would always hear your peers, everybody around you talking about, it's time to sell and everybody should move out. Uh, you shouldn't be sitting in the market at all. You shouldn't take that sort of risk with your money, right? Then the scenario comes where everything starts looking extremely good, extremely rosy good, like how things are right now. And what happens after that is that investors start and savers start talking about, no, this is the right approach. This is what you should be doing right now. How can you stay away from the market? You should be buying more of this and you should be buying more of that. And that's where the over optimism starts coming in and takes over that part uh, in periods where things start to look good, right? So everybody starts assuming things are extremely good, and this is how long-term market cycles work. It's all sentiment driven, and there is a good amount of capital cycle that does come into picture. So everything is sentiment driven, right? So when there is more greed, you would hear more of investors telling you, or more of savers telling you that this is the time for you to go and start buying. And when there's fear, is when they would tell you to start selling, but that is not the right approach. Right. To have a stable, consistent wealth creation journey, you must always participate when there is a lot of fear. Right. Your participation levels during times of fear is what is going to determine your outcome during times of greed. Right. So your participation levels always have to go up, and this is what milestones to wealth actually does. In a boring market is where we would like to go aggressive. Right. This is where your risk sort of comes into the picture. That when is it that an investor can sort of go out and start taking more risk? More risk doesn't mean that you will get more return. Right. Risk management has everything to do with how much am I going to lose? Right. How much am I going to, if my capital, if the probability of my capital, of losing my capital is more in one particular idea, one particular asset class, or one particular category, then I should not be going there. Right. I should always start saving and parking my money where the scope and the probability of me losing my money, right, is less. Right. Of course, there are volatile times in the market. Of course, you will go through a lot of pain periods of not seeing your money making a lot more money. That is because you're comparing it to another particular idea, right? So always look to always look for capital protection, and that is what risk management in the sense sort of means. It's not diversification. It's nothing like that. It all has to do with uh, my probability of losing money must be lower than if I put my money somewhere else, right? So in a boring market, we always encourage investors from a behavior perspective, right, that your participation levels must be more. That you can do with a mix of lump sum, you can do with SIP, you can do with STP, step up. But the point is that yes, you must be more aggressive at that point in time, right? During exciting markets is when you should let things play its own course. Unless and until markets peak out, unless and until you have met your particular goal, right? Now, when you're setting a particular milestone of say, yes, I want to achieve 10 lakhs and then 25 lakhs and then 50 lakhs, whatever your milestone may be, right? To and your milestones are being set to meet a particular goal, right? And let's say you are close to meeting your children's education, you are close to meeting your house goal, that target corpus is coming for you, right? At that point in time, you should take that call, say, yes, I am very close to my goal, right? I don't want to take any more risk with what is currently happening in this sort of a market. Now is time for me to reap that benefit, right? So always look to reap your benefits only when you're close to a goal, or second, when you are looking to play market cycles which is extremely long term. So retirement corpus your target for retirement will obviously be 20-25 years from now. You will get multiple cycles to sort of invest in. So at that point in time is when you have to take that call, saying yes, markets are peaking out, valuations are peaking out, things have looked extremely good. The signs that are clearly visible to me are that yes, I must take some money off. Not that I should not be participating, but my participation level should be lesser than what it is in an aggressive market. But I should not miss out on participating. Where is it that I should be participating? Where is it that I can take that risk on approach right now? Right. So, what do you mean by risk? I think I was very clear also, but yes, what is your perception of risk? You can just put it in the comment box. What is your perception of risk? without taking any risk that is a real risk. If you can please elaborate. Not losing any profit or capital. Okay, agreed. Not losing any capital, but the probability you there will always be a scenario where you will lose capital. The probability of losing capital must be lower. Risk is how much we can lose. Agreed. Not beating inflation. Yes, that is a very good point. Not beating inflation is a very good point. Knowledge of the downside before jumping in. Yeah, probability of losing capital, downside. Okay. So it's all getting basketed into one. I think this not beating inflation is a very good answer. Losing your entire profit pool just before the goal is arrived. Okay. So we'll try to take another approach towards, risk. Yes, in a way, uh, all of you have said more or less the same thing, that yes, the probability of me losing capital, if it's higher, then I am taking extra risk, right? But when you want to make that extra return of, let's say, 12 and 15%, you obviously have to take that risk, right? But the point of this sort of 2 3 slides going forward also is to just give you this perception of how to look at risk, right? Where is it that investors actually, why is it that there is a dichotomy, that there is extremeness when it comes to taking on risk, when it comes to you saving your money? Why is it that you feel like you've been missing out all these years, or whenever you have started your investing journey, right? How is it that you should actually try to look at risk? Hey, this is Ben Graham. Ben Graham is the father of value investing, and I don't think the objective of investment should ever be to take a risk in order to get a return, right? I think the objective of shrewd investment should be to find opportunities which offer a larger return than the average, combined with adequate safety, right? So basically, what he says is that I'm not going to take a risk just because I need to get a return, but what I would do is, with my money, I just want to park my money in opportunities that can offer me more return than the average with adequate safety, which means that it must be a beaten down idea, right? You must be contrarian with a high conviction for you to actually park your money in an investment avenue where you see that, yes, there is a good amount of safety here. I would make more than what I would think. Uh, if I had put in somewhere else where the risk is higher, where the probability of me losing capital is much more higher, right? I don't want to park my money there, but I would park my money somewhere else where where the assumption is that yes, it's going to give me more than that, and if it falls, yes, then I'm getting much more than that. But it's also safe, so you have to be contrarian in nature. Like, this is what he's talking about. Now, what have been the drivers of portfolio return? Right, portfolio return ever since the 2000s era has had fund manager skill and factors. You're seeing a lot of quants coming in, right? And a lot of quants have been driving return, right? Uh, and you're seeing a lot more factor-based investing coming in now. You're seeing many NFOs coming in on the quant side. And what is it that they're doing? They're trying to get the emotional bias out of investing, right? They don't want the fund manager's mistake to come and affect the returns. They say, I want a particular model that is going to give me buy and sell. My human intervention is only going to come from a point of, no, I think the model has given me particular, ideas, but from a fundamental perspective, it does not look good. It just looks good on, either it's on momentum or it's on liquidity, right? That's it, right? But if you look at history, it went from a skill to now something that is more computerized, right? To now something that is of a quant model, right? So if you see, the skill has been coming down. So your active management uh, uh, has not outperformed your quant models in the last 4 or 5 years, right? But again, it's more alpha momentum driven, where the risk is extremely higher, right? And it's all somewhat backward looking, right? Now, Sorry, just give me a minute. I think I just got disconnected. Just give me a minute. Yes. Sorry, I think I was having some problem with the PPT because I think I missed a slide. So this is it. So what are the drivers of risk? So if you look at, when we were talking about risk, and it was only more from a return oriented perspective that if I take higher risk, I'm going to get higher return. But what is the base of what should be the base of your ability to take risk? Your very first risk is what you save in fixed deposit, is what you save in debt mutual funds, is what you save as insurance, right? Your actual personal drivers of risk, right, are your first shields or your first defense mechanism. Today in India, we are having another NFO for defense, and defense has caught the eye of all investors because it has done extremely well, and defense stocks are going up and becoming multi-baggers over days, right? But we are only seeing this from a market perspective, but we're not seeing this from a personal perspective. Right? Your personal perspective needs to be, yes, what is my first line of defense? How is it that I'm going to be able to take that particular risk? Right. So from a personal perspective, you need to have enough contingency for you to last at least your 6 to 8 months of your expenses need to be in contingency. Second, you need to make sure that in terms of insurance, you're well adequated in terms of term and in terms of health. Right. That sets the base for you to say, yes, I've saved enough. I'm quite safe right now. I have enough adequate levels of safety. I have enough armor for me to go and start taking market risk. Right. Once your base is set for your personal risk appetite, then you can start going and taking in market risk. This is where your stock portfolio comes in. This is where your mutual fund portfolio comes in. ETS, whatever you want to do, is what you do at this point up until the market risk. Now, what is aspirational risk? Here it says concentrated stock holding, other risky positions. But I would like to ask all of you a question. What do you think is an aspirational basket? See, because we have not seen all these things, when you read online or when you read the newspaper, everybody talks about risk in terms of small cap investing or mid cap investing. If I take a diversified approach, then my returns would look extremely good. But here we are not talking from a perspective of returns at all. Up until now, we have not spoken about returns, right? Up until now, we are only talking about what is driving behavior, right? And how are we setting ourselves up to take on risk, right? So my question to you: what do you mean by aspirational risk bucket? Okay, investing in private equity, for example. But the point is that here we are dealing with, uh, yes, but retail investors don't really get too many options to go and start putting money in private equity, right? We're being very honest. Private equity right now, retail investors are not getting that much of big of an opportunity unless and until you have a 1 or 3 crore ticket size where it's an AIF where they take advantage of investing in private equity. But not a lot of options for retail investors to take advantage of private equity, right? So where is this aspirational risk actually coming from? Startups, private equity, okay, very similar. FNO, I agree. I completely agree with FNO, right? Where you misguided to say that this is an aspiration, right? You're completely misguided to say that yes, you will be able to meet all your aspirations if you take on complete. You can continuously keep on taking risk, continuously keep on taking risk, and that's complete misguidance. Right. So I agree with FNO. Yes. Though it's a misguidance that yes, investors are being made to see that yes, if you do this you will get in more returns, and that is aspirational because you want to meet your goals faster. Right. So I agree with FNO that you are made to see that this is aspirational. Yes, cryptocurrency, Bitcoin. See, this aspirational bucket is so small, right? If you see from the entire pyramid perspective, the risk pyramid, right? Your aspirational bucket is very small, yet the impact that investors think that aspirational sort of makes the weight that they are attaching to the aspirational bucket is so high that we forget that it's not within our risk appetite itself to go out and start taking that extra risk. Cryptocurrency like Bitcoin, yes, there was a period where everybody was doing cryptocurrency, right? What we forget as savers is that your personal risk bucket should be the base, not your aspirational base bucket. Your aspiration should drive you to save more, right? Not to take on more risk, right? As you start getting mature in your journey to create wealth, as you see a couple of cycles today, a lot of investors have come in the last 2.5 years. They're all new investors, right? They do not have much experience. They've only seen a one way up, which is a bull market, right? So for them, aspiration is what is driving decision making, right? But uh, what should drive is your ability to take on that extra risk. Once your personal risk bucket is set, then you can take on market risk. Once your these two factors are working very well for you, these two drivers are working well for you, is when your aspirational bucket actually pushes you to aim higher. Right? That yes, I want to start saving more. I want to start saving more. I want to start saving more. Not from I want a high return, high return, high return. Give me an idea. Give me something where I can get an extremely high return where I can get a multi-bagger. Right. So always remember this, and all of this is public data. Right. Always remember this that first line of defense is always your insurance, is always your contingency reserve. Only then you can start actually thinking that yes, I can start playing on the front foot and start taking on and be consistent in investing in stocks or mutual funds. Here the subject is mutual funds because here you're able to get the best of everything in one basket, right? So always look to mutual fund investing than direct stocks, right? Your aspiration should be your driver to save more, right? Here also it's given that yes, you must. It aspiration is concentrated is investing into foreign stocks. No, for all you know, you investing into foreign stocks might actually become your market bucket, right? If you're very well attuned and very well, you go through the market cycles extremely well, right? You have seen, you have learned, you have experienced, you have matured as an investor. So all of this would come off in your, market risk bucket, your private equity, everything would come off in your market risk bucket, right? So leave that space for aspirational bucket for you to be able to save more, strive better, do more. Do more is what Milestones to Wealth is all about. Strive more and do more is what your aspirational bucket must be. Right. Now let's look at what's happened. Right. Let's look at where the risk has actually been taken. Right. This is slightly dated, but in the next slides you would see, updated data. But if you see from this approach from 2012, you see small and mid caps actually, driving returns in the entire market. Right, mid cap has always been consistent in being number two, even if it's a bad year. Right, so you are seeing people take on extra risk rather than understanding how that risk is actually, how that risk actually should be taken. Right. Again, if you see from a style, because today a lot of investors are seeing information on style, right? This is where your quant models are coming in. You see your nifty alpha models, you see your nifty value models, your momentum models, right? So if you see from this perspective, every time that there is a different winner, right? Winners always are going to rotate, right? So the only way where you can actually make that larger return than average by taking on lesser risk, which means you are taking more risk, right? But theoretically you're taking on lesser risk because there is enough margin of safety for you, right? Is to be contrarian, right? So if you see here, alpha momentum has done extremely well. Where is quality? Quality has just done well in periods of bad time, right? 11, 13, 18. Whenever there is a bad phase, your quality has sort of done well. But whenever there is a risk on, extra risk on, right? There you see your value has done extremely well. And naturally, as market starts going up, volume start coming in, your momentum starts being extremely well, right? Your first is always alpha, and then you you see that yes, value is also doing extremely well. So basically, everybody is on yes. I don't think that anything is going to go wrong. So let's go on and start taking that extra risk, right? If this is that chart that says that winners keep rotating, right? If you see, and this is a chart that is a favorite of mine. Every year we keep updating this internally also. So if you see from a debt perspective, your debt did extremely well during your 14, 15, and 16, right? And your small caps started to do very well after the COVID, uh, boom, right? But we had this period of 14 to 17 where within equity, equity was doing extremely well, right? Within equity, we had, small caps in international do well, but at the same time, we had debt do extremely well. Right. Then there was a period in 2010, 2011, 2012 where your gold did well. And then you see gold 13, 14, and 15. So winners always keep rotating, winners always keep changing. Right. So it gives you ample amount of opportunity for you to have a risk on approach into avenues that provide you enough adequate safety with also the opportunity of larger returns than average. So today, from 18 up until now, gold has been the best performing asset class, right? And the opportunity in gold still remains very high. You can still make those larger than average returns because there is not a lot of risk when it comes to investing on the gold side, right? So 18, if you look at 18 all the way to now, gold has been stellar in terms of performance. It remains to be in the top three. Uh, so yes, that expectation also is extremely high. Right. If you look at sector wise, just look at sector wise alone, right? You see metals, public sector, real estate do extremely well. Again, it is an extra risk on approach. So if you look at the past, right, you will be inclined to say, no, if this has done very well in the past, so I might as well go and start investing only in them, right? This is where your bias starts coming in, where you're only looking back, where you're only looking back to say rear view investing. Things have done very well for me for the entire market. I might as well do this, but that's not going to give you larger than adequate returns. That's not actually the driver for you to take that, right? That's not where you are actually going to start making that return. Once you're set with your personal risk basket and you take yes, my market risk basket. That's where you have to start going and telling yourself that no, I need to look at other and fresher ideas, and that's what investing is all about. Always look to have fresh ideas. Now, if you look at this particular chart, there's private banks that are the least performing, right? There's FMCG that is the least performing. Now, why is it that is there any problem in terms of private sector and private banks and consumption do poorly? Second, debt. Debt is somewhere around 7.7%, right? In your corporate and your uh, GSEC, that is government, is that bad? Right? Is that bad from a perspective of a country growing at 8%? Right. I'm asking all of you that question. Is it bad that on debt, where we've had a cycle where debt was not giving you more than 5.5, 6%. Today, we are at a place where it is somewhere around 7.6, 7.8% from a longer term perspective, with India poised to do extremely well. Is that a good option for you? Right. Then comes your gold, and that's what we will cover going forward also. From your gold and silver perspective, is there a good enough opportunity? Because things have done extremely well on that side. You look at small cap, mid cap, international, right? Things have been doing extremely well on that particular side. Your large caps have been very consistent. So large cap was again is a fantastic opportunity for investors to go out and start investing in. Right. So on that side where investors have already been rewarded for taking on risk, can there be more reward? Next question. Where there has not been any risk-taking ability shown by investors, can there be an option for investors who say, no, I'm going to have a risk-on approach here? Uh, can there be a higher reward than the other side going forward? Right. Now, if you look at this, money is chasing trends. Right. So if you look at sectoral and thematic, and then if you look at small cap, right, 81,000 odd crores has gone into small cap the last 12 months. Right. And this is on 31st May. This is very updated data. Right. So a lot of money has gone into small and mid caps again, right? Around and sectoral and thematic. Sectoral and thematic, yes, you had a lot of NFOs, and the performance have has actually also played a role. But there have been many NFOs that have come up on the thematic and the sectoral side. So yes, a lot of support has gone into those funds as well. But if you look at from a category perspective in large, mid, and small, your large cap still net flows in the last 12 months. Can you believe it? Net flows in the last 12 months is only 1,700 crores, which means investors are actually have been pulling out their money from large cap funds in the last 1 year. Right? Large cap funds, where these are the creamiest layer of the entire market, where the return metrics now are improving, and they have the ability. If India has to grow, then the bigger have to grow. Right. So if you just see from that perspective, from a net perspective, your large caps have not done extremely well in terms of flows, and your small and mid caps still continue to get that extra money of 40,000 crores, 25,000 crores is net. So still there is profit booking, but at the same time, the flows that are coming in are much more higher than that profit booking. Right. Again, we've had a good amount of inflow into multi-asset. Multi-asset also, we have seen some good amount of NFOs that have come in. So where is it that investors are taking on that risk? Again, it's chasing returns. It's not actually a well-calibrated tactical approach to taking on risk. Right. So it's all past, it's all hindsight bias to say that yes, this has done very well, so now I'm going to keep on putting my money here because I have a long term horizon. I'm going to invest for 20 years, and this has done very well for the last 10 years, and I will still continue to do this. Can an investor continue to do that? My answer is no. Right. Again, if you see from the last, so if you just see from a month on month perspective, right, from your net flow perspective, if you see there is money going in now into the large cap space, right? Money has been coming out. There has been a slowdown in terms of money that has been going in into small and mid caps, though it is still continuing to go in. But if you see from an incremental perspective, where is the extra money also starting to go in? It is going into large caps and large and mid cap funds, right? So there is a pocket of investors who are taking a risk on approach where there is a scope for you to make larger than average at the same time take on lesser risk. Okay, so there are a set of investors who are doing this, and for anybody who's on milestones to wealth on the program, they are already in that bucket. They are already in that basket, right? Of how you can take this sort of risk on approach, right? But my very first thing would always be: is your personal risk bucket covered? Only then we will move into market risk. Otherwise, we will first work only. It's a hand holding process. We will first make sure that your personal risk bucket is very well covered. Right. So, where is the next opportunity to take on risk? My question to you: where is the next opportunity for you to take on risk? Okay, then there is IT, banking, infra, large cap banks, fertilizer sector, private banking, auto, recycling industry, large cap, EV, housing finance, large caps, gold and private banks. Okay, sugar, logistics, defense. These are all the comments that are coming. Asset management companies, pharma, okay, hotel industry, solar, purified water stocks, AI, okay. But don't you think AI is already at its peak? FMCG, mind you, this is all in the place where I'm talking about. There is enough probability that I would have lower loss in my capital. Again, this entire thing has only been where is it that I can take a high risk with the probability of me losing my probability of losing capital is less. Not that it's not there, less. Real estate, I think you're going to say chemical and private bank. No, I'm not going to say chemical at all. Domestic businesses which are not exposed globally, example telecommunication. Telecommunication does have global exposure, and global technological advancement do affect telecom. Banking. Okay, I think most of you have are somewhere in that area of large caps. Yes, within large caps, banks. Yes. So we look at some data. Large cap with careful selecting reduced risk. Okay, I agree. So this is the risk model that we're going to take in Milestones 12. Like I said, in a boring market, as delegates of the program, you will always be trained to be aggressive in a boring market and conservative in an exciting market. Now, do you think that it is a conservative market or a boring market? Sorry, an exciting market or a boring market? You're in the middle. Okay, you're in an exciting market. Okay, exciting, boring. You can say very boring also. You can say very exciting also. No problem with that. I appreciate the middle, definitely. Boring market for large cap and exciting market for small cap. Interesting. Right. So here I have put conservative, and I do believe that yes, things are very exciting, and they've gotten to a point where people are scared also now. Right. I've put conservative. Conservative does not mean that you don't take risk at all. You just take risk in another avenue, in another place. Right. And that doesn't mean that you look towards products that are, sort of hybrid or BAF for that matter, because BAF today, I don't know if you've all read that article, but there was good data that came in on live and that said that there's a lot of overweight on equity even within these models, right? So where is it that you should be taking on risk? Yes, equity is the only way where is offering you high returns when you take on that extra risk, right? Extra return, extra risk, right? So extra return right now, where is that next opportunity for you to take on risk, right? Here, if you just see from a point where there is potential for earnings to grow, at the same time they have been trading at cheaper valuation, right? Now, two things that I only wanted to take stock of is one, the potential for earnings to grow, and my ability, if I put my money here, my ability to lose my capital is low, right? Because yes, there is a scope of earnings to sort of compound, right? My ability to lose money is low. Forget gaining money. the probability of you for me losing my capital is low. I might not make money for 3 years or 4 years also, but my probability of losing money is low, right? So I think in the comment section also there were a good amount of comments that came in on the banking side. So I'll just skim through this fast. Why banking? I think all of you know that yes, we have had a good cycle where NPAs have been improving. For us to have strong economic growth, we need to have strong credit growth. We've been seeing strong credit growth. When strong credit growth does come in, your banks actually are the backbone of your economy. Uh, if it has to grow at 7.5%, 8% for the next 5 years, 10 years, right? Then we have basically India is very underpenetrated when it comes to credit, when it comes to mortgages, when it comes to life insurance, when it comes to our investments into mutual funds, right? So we are very underpenetrated when it comes to other developing and developed countries, not only developed. Don't when you're comparing to another developed nation, demographics are different, everything is different. We are a country where we have the best demographic profile, right? In that particular part, yes, when we compare ourselves to other nations with similar demographic profile plus developed nations, we are still lagging in terms of market penetration, right? So there's enough scope for us to start getting mature as savers and investors in India and accepting more and more products that work for us. Right? You will get a lot of innovation when it comes to such products where we will be able to take advantage of it. Right? So it's right, there's enough scope for us to sort of grow. Now let's look at the fundamentals. Now banking forms 38% of the profit pool in the top 500 companies, but it's just 26% of the market cap. So profit pool is very high. And the last 10-year profit growth for banking has been 17%. Top 500, if you take out banking and financial services, the entire part, right? That profit pool has been growing at a much faster rate than the rest, right? But last couple of years, things have not looked extremely well. This is because in that peak, let me go back to that peak here. Sorry. Yeah. Now, if you see here, 18 and 19 was this sort of period of peak for this particular sector. And after that, you saw IL&FS crisis happen, DHFL happened during that 17, 18, and 19 period, where that effect on earnings had still not come in. Once that started to come in, if you see, private banks had been lagging, right? Public banks also were lagging during that period, but then suddenly public banks, you know, the asset quality change and the first round of re-rating always happens, down the chain, bottom of the chain, then it comes only to the top of the chain, right? So if you see now, it has been lagging ever since 2018 and 2019. So you know that there is enough bad that has happened, and there's enough good that is already taking place, right? Right. So if you even see from a performance perspective, your current underperformance was this is slightly dated. The current underperformance is still near GFC bottom, though there has been some up right now. So you can say that yes, it has come up, but not as high, right? So there has been drastic underperformance in the last 4 years, right? From a sentiment perspective, right? Fundamentals are already come and now fundamentals are changing, but from a sentiment perspective, things have looked extremely, poor, right? Likewise, here if you see this peak, this premium that they were trading at to the broader markets, it was very high during that 18-19 period. So every time you see this sort of metric where things are trading extremely high, this is your exciting, right? Here's a cycle. This is your one cycle right now that you're seeing currently, right? So extremely exciting became extremely boring. Extremely boring means yes, time to be aggressive. Extremely exciting means yes, thoda we should not be as aggressive as what we could have been or what we can be in the boring part, right? So next, look at consumption. India's is poised to grow at 8%, 7.5, 8%, and we are at an inflection point, which means we in the last 3 4 years, if you see, we've been spending a lot more. Yeah, inflation has been high, but we've been able to weather that inflation. We are spending a lot more. And India has always seen inflation. India is not that a country that has never seen inflation. We have always seen extremely high inflation, 12%, 14%. Right now, we have been able to weather on this inflation. We are spending a lot more. We are traveling a lot more. Discretionary spends are much higher, right? So, what are the factors that are driving consumption growth? India's consumption is now at an inflection point. We are crossing 2,000 crore uh, GDP per capita income, right? India is, like I said, the demographic profile is strong. So these are all long term trends, right? And we have seen how these long term trends have played out, where the delta for consumption is higher. You see, digital has done extremely well, right? So premiumization has done extremely well. It is continuing to do well. We are now consuming more and more premium products, right? So changing habits, higher disposable income. These are all slow things, but in the last 20 years, we've seen a good amount of us taking on that premiumization. Our appetite to take on more premium products has gone up. Like this sector is becoming more and more organized. Right, you're seeing more organized players starting to come in. If you see more startups also coming in, they are also entering into that formal economy because GST and digitization has actually made it very easy to become much more formal. Right now, if you see here, if you compare ourselves to other countries, Indonesia is very similar to India. Right, their FMCG per capita consumption is much higher than us. Right, not that we would not be spending. Yes, for us we are spending, but it's much lower, right? We are still, as we start filling our pockets, we will be filling other people's pockets as well, right? So this trend will take some time, but it is a trend that has been taking place in the last 10 years, right? So if you see everybody else, if you just compare ourselves to everybody else, this is not a direct comparison, say they would go to that, but we would see improvement coming in on our side, right? If you see, this is aspirational India. We had an aspirational risk bucket. Now we look at aspirational India together, right? If you see 2005, how this pyramid was and what it is turning in into now, you're seeing a lot more coming in into upper middle class and high class, right? High income households, right? So we are seeing this trend, and this trend is currently also happening. So 2018, we saw this happen. Since we are expected to grow, this again would start taking place as more and more households come into the upper middle income bucket. You will see spending starting to take place. You will see. So this is all long term. Right? This is not like a 3 year or 2 year thing. Don't expect what happened in the last 2 years to happen every time and everywhere. That's not going to happen. Right? If you see just now from whether it's boring or exciting, I would say it's in the middle. Right? We are not in a boring place, but it's not very exciting also. It's still somewhat in the middle, but uh, it still is slightly on boring, but not fully on boring. Right? To be very honest with you, there is a good amount of it being on the middle side. Right. If you see Nifty is exciting, right? So within Nifty, you're having one that is extremely boring and one that you have is somewhat on the middle. So the approach to take on aggression is different. Now, in a boring market, what would you do? Right? Milestones2Wealth always says that when you participate, how is it that you should participate? Prioritizing the level of participation is important. Now, in a boring, look to prioritize from a lump sum SIP and then step up, right? Extremely boring, that should be your first option, right? Somewhat in the middle, there you can have a SIP, step up, flip it, SIP, step up, lump sum, right? In your lump sum also, it should be staggered. So it's not going to be straight say, yes, things are looking extremely good, I will go plow my money into one day. That's not how you build wealth. That's not the right set of behaviors as well, right? Your personal risk basket gives you that ability to take on market risk, right? As you start getting more bonuses, as you start saving on more, your ability to take on market risk is much higher. Where is it that you take higher approach? Your participation levels is where you can take on that extra and you can show that extra aggression. Now, let's look at silver and gold. Then we can I have just two more slides on on debt. Then we can open the floor for Q&A. All right. So it's not silver versus, there's always silver and. So if you look at how gold has done, this is global gold, it's not Indian gold. If you look at how gold usually does in an inflationary environment, when there is strong inflation, uh, gold does extremely well, right? So it has proved that yes, it is a sort of a hedge to inflation. And in this sort of a scenario where there is a lot of geopolitical tension, you need an alternate currency in your portfolio. That is gold, right? So if you look at silver again, from a supply demand perspective, there is a lot of gap in terms of the supply. So basically, what has happened since 2020 is that supply, that is basically what demand has gone much more than supply, right? So these are two options that, from a precious metal perspective, is what is giving you that approach to say yes, things are there is a long runway where the probability of you making more by taking lesser risk is higher. And because uh, it's for commodities that there is a rebasement that happens. It's not like equity where it's just you have to take physical stock of it. When in the commodity markets, we have to take physical stock of it, and central banks have been buying gold. If you see, even in the news, China has been the largest buyer of gold this year, even in the last year. So central banks are shifting more and more of their reserves, that is in dollar, to precious metals like gold. Right. So that shift is currently taking place, and that's not like ETF where it's only based on sentiment and consensus. Right. It is physical demand, which means you have to store it somewhere. So it's strong demand. It's actually a strong sign to say that yes, this is adequate. This price is very good. That central banks are also buying it, right? So we have seen a supply mismatch where the demand is much higher, and you're seeing this across commodities, right? Now let's look at one more thing. If you look at the gold mining industry and if you look at the silver mining industry together, they don't even match up to the entire. It's probably just one third of the entire energy sector, which is still very small. It's more driven by oil, right? Oil and gas, but this sector is still extremely small when it comes to the entire energy sector pack. But fundamentals have been improving on this part. So I have done one proper webinar on gold, silver, and gold mining, and you can just go to Milestones2Wealth on YouTube. You can just check that yes, this is avenues where things, fundamental perspective, things have done extremely well. But sentiment wise, it's not reflecting that true uptick in terms of fundamental performance, right? But if you see just from here, it's not been given that right attention. It's not been given that right love that investors have been giving to small and mid caps. Right, this is across the world. Across the world, you're seeing only technology do extremely well. Right, investors are only plowing in money into top seven. Right, so everything else is shunned away. So this huge opportunity for investors to take advantage of when everything else is shunned away, and you can only go into places where yes, the ability for them to compound money, that is from a fundamental perspective, to earn more on a balance sheet basis plus a profit and loss basis is much more higher. Right. So if you look at it from a valuation perspective, it's always cheap. It has been cheap since 2015. So anybody who has said no, I'm going to take that aggressive approach here has still not seen glory. Just from a valuation perspective, though the earnings have been growing, and still that glory part has not yet come, right? But if you see from the last in the last 2 3 months, since gold has done extremely well, their miners also are poised to do extremely well. So always you would find some bit of delay in terms of performance. This is because if you saw from 15, 16, 17, 14, 15, 16, 17, that's where your gold price was going down. Right? Only from 18 onwards is where you saw things started to do extremely well on the gold side, right? Across the world. So naturally that would come in onto mining. It just works normally like how price of steel works here, price of aluminum works here. So yes, that delay is where investors are getting that opportunity to take advantage of good earnings compounding at the same time, lesser risk in terms of valuation. Right now, let's look at long duration funds. This is where options are. This is where investors can take that advantage on the debt side also. It's not alone equity, mind you. It's not alone equity. There is amount that you can take on the precious metal side and on debt. Long duration, if you see, India has done extremely well in terms of its structural position. We've had a shrinking current account deficit. We are expected to get in more money because we are getting included in the bond index. Plus, our fiscal deficits are not that bad. Right, if you see last the inflation commentary also that came in, it was moderate. 4.5% is what the RBI is also expecting, which is well within our 4% plus two or minus two. Right. If you see, even global policy rates have been peaking out, though there has been a decoupling of interest rates. Basically, you see other countries not following the trend of what the US Fed is doing. Right, every man is for himself now. But I think 2 3 days back, even the Bank of England said we are not going to cut our rates. Even the Fed said that we are still waiting. We don't want to cut our rates yet. Right, but we are seeing this scenario where policy rates are sort of peaking out. And India is in a very good shape structurally. So why is it that we are still having a 7.2, 7.3% GSEC rate? We are getting added. These are all public news, and we are getting in money. So FIIs have been selling out of Indian equity, yes, but they have been pumping money into Indian debt. Right, foreign investors have put in $2 billion worth of debt investments. I think that was, I think it's the second highest. In 2014, they had put about 2.7. Right. So they are participating and they are taking on risk. But where is it that they are taking on risk? They are taking on risk in Indian debt. Right. So as we get included in the bond indices, global bond indices, we expect to get about 20 25 billion dollars worth of flows in a year. Right, which is high. So there is enough scope where liquidity will be taken up. Right. So what happens if you take this sort of exposure towards debt? Now, if you take at current yields, and current yields are somewhere around 7.2, 7.5 only. If you have a rate cut right now, right, you stand to make in a year 12.5, 12.7%. This is all pre-tax, and your 3 year returns will be much higher at 8, 8.5%, 8, 8.2%. Right. So going forward, we don't see interest rates going up. Peaked out, yes. India doing extremely well, yes. Flows coming in, yes. So can we? Where is it that we can take on risk on the debt part? Right. So you can afford to take that extra risk on the longer duration side, and you stand to make more on the longer duration side than you would assuming that things look extremely bad on, because valuations have been peaking out. It's not boring, right? It's very exciting right now, right? Where there is a chances of valuation derating. Where is it that I can save my money, make larger returns than average returns? Are only when you look outside of the particular universe where money is chasing trends, right? And money is not chasing trends here. Money is not being chased here at all, right? So on debt, you stand to make somewhere about 8.2% on a 3 year basis. This is pre-tax, which is very good. For a debt product, which India is currently in a very good shape. So yes, you would have very good returns also coming in on the debt side. So I think I've covered a lot, and now I'll open the floor for Q&A. I think I've covered a lot in this particular webinar. So now I'll open the floor for Q&A for some time. We have some time, so let's do some Q&A. Rules for the Q&A: no stock specific questions, industry specific questions, sector specific questions, all okay. No stock specific questions. If I sell in Indian equity markets and those amounts will get invested in undervalued market like China and Japan, what's your view? Japan not undervalued anymore. Uh, China, there is China is going through its shift of old economy to new economy, and that would take some time. So stimulus also is going into new economy type of capacity addition. It's not going to old economy. So they've told the old economy. The signal is that old economy, you survive how you want to. We will not give you steroids, but new economy is where they are starting to look. That would take some time. It's cheap for a reason. When something is cheap, it is cheap for a reason. Right. So for somebody who's saving money, uh, right now you should not look to take that risk. Right now, where is it that you can take the risk? I've clearly told you where is it that you can sort of have that risk on approach. US election will have an impact on our market. Yes, it will have an impact on our market. I don't know how much would be the correction. You should not think like that at all. You must think that yes, there can be volatility, and when there is volatility, where do I need to participate? Right. When you participate in places where things have been beaten down, the scope of you losing your money is slightly lower. Right. So, but yes, there can be some some surprise that can come. We had a surprise here. There can be a surprise there also. So in the current scenario, multi-asset allocation funds have large allocation to longer duration debt. See, multi-allocation funds have a specific mandate where they need to have a fixed chunk in equity, about 40, 45. Some have 50, 50, 60. Some have 35, 45. So, a mix of everything. When we look at doing debt, we try to take a direct approach on debt. We don't do hybrids or BAFs or multi-asset because we want the control on debt. See, our risk management that we do on debt is far higher than what we do on equity. Why? Because on debt, it's a dealer-driven market. When you take that call on debt, you're stuck. At least on equity, there is enough liquidity in the market. But on debt, liquidity is lower because somebody has to be on the other side to take on that particular paper, right? So we try to take up complete control of it. We don't. We want to take up complete control of it. So we would do a direct allocation towards, corporates and corporate bonds or via mutual funds. So we will do everything via mutual fund. There is no stocks or there is no bonds that we would do, but we would take that approach via mutual funds, but direct. That is 100% into one particular debt idea. Your view on renewable energy? I mean, renewable energy is so we've had a mix. India uh, is that particular country in which everything would thrive. You would have dirty fuels that would thrive. You would have renewable energy that would thrive. So everywhere we are seeing even now, wind is doing well, coal is doing well. Basically, in terms of use cases, right? Not in nothing in terms of stock prices. Use cases, right? Is it being used everywhere? Yes. So right now, from a valuation perspective, it's very expensive. But from a future use case, India is that particular country where you would have use cases everywhere. I mean, everything would get used. Could you help to share where we can park the money during these times for safer and deploy to? So what you can do is just send us a hi here, and based on your goals and based on your risk profile, what we do is that we would first take a financial health checkup for you. Right, this is what Milestones2Wealth does. When you go to the doc, the hospital, you take a full body checkup, right? To know if things are okay inside, not okay. What is it that you have to take? Any medicine? Are you fit? Are you not fit? So we would take a financial health checkup for you, where we will see if you're financially fit or not. Right. Once we do that, we will get a clear direction of how much you can save and your potential to save. Right. After that, we'll take a risk profile test to see your ability and your willingness to take that risk. 3 checklists done. After that, we would look at your particular goal. So three, right? One is your health checkup, then is your risk, then is your goal. Once these three are done, we'll park your money based on that particular goal requirement, and only then we would eventually deploy it into equity based on your particular goal, based on what your requirement is. Right. So this is a case specific sort of question. So just send us a hi. Somebody from the team will have a one-on-one discussion with you. Just send us a hi on this number. What is your view on high growth section in current government, Modi? I did a webinar, I think last time itself, on what can happen in India 3.2 and how coalition governments have, uh, what has been their contribution, how have they fared in the past. So you can just go to that. In a nutshell, uh, you must only try to look at where market is giving you more opportunity by taking on lesser risk. We've covered a couple of options here, and I have not been biased also towards equity. So these are options that you have. Uh, Wait and see what policies are coming out. Only then I will cover one more webinar at that point. Say that yes, have things changed? As of now, it doesn't look like things have changed. Continuity is the signal. So don't focus too much on that. Focus on right now. Change your focus. Focus should be now on uh, where is it that is giving you a cheaper opportunity right now. And we've covered. I've given you enough information on what you can take advantage of. Since FIs are selling and most of the holdings is in private banks, don't you think it will add pressure to private banks? See, FIs will always come and go. Forget about them, right? Uh, FIs have not only sold out on, they've been selling out on MNCs also, right? FPI, right? So you're seeing larger multinational companies sell out their stake in India, Indian subsidiary, Indian companies also. So our domestic inflow is very high. We have 55 lakh crore mutual fund area, and we are consistently getting 22,000 odd crores worth of SIP. So domestic, you and I are basically supporting what's happening right now. So if you see, it's not giving you a lot of time. What happened during election day was bought out, and today we are already at an all-time high. So doesn't matter what they do. What matters is what you want to do and what we need to do right now. Private bank large cap is now at an attractive value. What's your view on the current market scenario? Any correction because we are sitting near at a 100-year cycle? I think you are aware of the 1929 era. Due to standard deviation, we don't get too much into these particular numbers. This number shows that yes, we are in exciting markets. All right. This number shows that we are in an exciting market. History has shown that excitement with excitement comes fear. Let me tell you that also. With excitement comes fear. Something goes wrong. It's like you're high and you're having an adrenaline rush, right? You're high. So uh, usually in these cases, what happens is there can come volatile scenarios that can come up, right? But all factors is what you need to take consideration of. Our country is growing, right? And because our country is also growing, fundamental wise, things are looking good. Now, India top companies, we've had a that is the top 100. We've had a 15 odd percent growth in earnings, but re-rating has not happened. So, from a fundamental perspective, you're not seeing a slowdown in terms of earnings growing. When that scenario comes up, uh, you have to be only cautious on valuations and not overpay. When you overpay, only two scenarios can take place. One, you don't make increment in return at all. So if you see quality did not do extremely well from 18 up until now. Okay, we'll go to that one also. Right. So quality was lagging since 18. Right. This is because valuations are very high there. Today you are seeing re-rating happening on the that is de-rating. Sorry, de-rating happening on the quality side since 2022. Right. So when you overpay, you run the risk of one, not making much money from a compounded growth perspective. Second, you run a very high risk to say that uh, uh, yes, there can be because so much of good has already been factored in here. Fatigue would come in, things would not meet up to expectation, and then you would have some sort of derating that would take place. Right. So don't think from a correction point of view. If there's a small correction, also you should take advantage of it because fundamental wise everything is looking good, right? So you should take advantage of it. Which debt funds should be under radar? So long definitely is. If you want to know if it fits within your risk profile, just enter the high and somebody from the team will get in touch with you. Don't Debt is not something that you should be taking extra risk in. Equity you can take, but debt is not meant as a risky asset. Pharma sector is at buying level. Pharma sector is extremely interesting. I have a plan to do a pharma oriented presentation as well. Maybe next month, next to next month. I'm waiting. I told in the last webinar also I'm waiting. So yes, I would do a webinar. So you would know that when we are sort of doing webinars, then we are actively trying to, uh, you know, uh, I mean the participation level there is starting. Milestones2Wealth is an iThought entity. Milestones2Wealth is a program under the under Smart Value, which is a mutual fund arm for iThought. It's a distribution arm, mutual fund distribution, but it's a program. So we do regular funds only. There's no direct, it's not advice. It's just regular distribution. But our idea for Milestones to Wealth is to work with serious savers, serious investors, and have them set that milestone of reaching 1 crore, which means you should save 1 crore. Now, uh, I didn't put this here because it's not relevant, but I think yesterday, me and another colleague of mine, Abhishek, we did an Instagram live from our official handle where we put a question out. I had asked him a question, and it's all published data on the outside. You just put it anywhere, you would get it. How long would it take you to reach your first crore? Okay. He was telling me that it would take you 10 years. Right. There is a good chart also by Funds India that says how long would it take you to reach 1 crore. It would take you about 7 to 10 years for you to reach your first crore if you just do a 30,000 rupee SIP where you don't step it up. Right. Now, as you go up and start stepping it up, right, you cut that sort of tenure by 2 years. Right. So it takes you 10 years for your first crore. And then after that, if you set that target to say 5 crore is a good target for me to retire, how long does it take you to reach the next crore? The next crore takes you lesser and lesser and lesser time. So by the end of the next 10 years, that is 20 years, you would have 5 crore. If you just be consistent in your behavior. That's what Milestones2Wealth is all about. So Milestones2Wealth is a program, right? Under the mutual fund arm. Is it the right time to invest in long debt funds? Yes. Do large mining companies like mine gold and silver, Coal India? No. How do you see factor-based investing in India moving forward since it eliminates the risk of active fund managers, bias, and emotions? A lot of agencies coming with NFO. Will this provide an opportunity for investors to attract and invest in products with reasonable risk? See, it's very interesting. The thing is, with all these quant models and all the NFOs that are coming in, it's a different quant model. They all have a different quant model approach, but none of them want to take away their uh, intervention of active fund managers, right? Everybody does not want to depend completely on a machine, right? Because when they backtest, it gives out shady names. It gives out it. Then it's just going based on momentum. It's only going based on alpha, right? So they do not want that. They want some sort of quality to come in, and that sort of quality intervention can only come from fund managers. So it's a mix. So whatever products are coming out now is a mix of quant models, that is factor-based models, and fund manager intervention, right? So it's still nascent. We have been also speaking to fund managers and are trying to understand the model, but it's still very nascent, and we would like to see how this develops, right? Models say that it has done extremely well, but let's see it in reality. What's been happening? Right? Let's give it some time. Let the funds, age a bit, 3 years. Let it go through another cycle. Where there is active work that goes into it. It's not back tested. So when active work does go into it, let's see one cycle. You're not going to miss out on anything. Don't worry much about it. It's a model. Obviously, it will give out opportunities, and everything is rotates, right? Winners keep changing, losers keep changing. So you'll obviously get opportunities. I would only request you to be slightly more patient, okay? Because even we are trying to see, we're trying to understand it. Let it go through one cycle. Could you please share your view on where we can study about sector valuations and which sector is attractive, expensive right now? You don't need to do it by yourself. You don't have the time to do it, right? Uh, I would always suggest to work with a financial advisor. See, the only reason of why we started Milestones2Wealth, and the target for Milestones2Wealth is to help 10,000 investors at the start, right? Uh, as we start getting, everybody has seen how the markets have rewarded everybody, and that always leads to greed. That always leads to some sort of misguidance. That always leads into uh, you taking in a wrong approach, right? But behavior is what you should be looking at, right? I would always suggest you always work with somebody who is experienced in the market, who knows how. who's been through cycles. Even when we are partnering with fund managers, we only like to partner with fund managers who are experienced, who have gone through cycles, who have seen how things take place, right? So, and in all honesty, right, nobody who is not in this full time has the time to study, to understand, because there are other priorities in hand. So I would always suggest that you work with an advisor, you work with a distributor, because they know, they've seen the industry in and out, they know what the trends are, they know what's been happening, and they knee deep into it. So I would always suggest that you work with an advisor rather than looking at websites, rather than looking at portals, rather than doing all of this by yourself. Always look to get professional advice. Right? If I Google, say, if I Google a particular symptom that I'm currently facing, it will always show on Google that I'm dying. Right? Don't do that. That's what is misguidance, right? You would always want to go to a doctor. You'd always want to go there because everybody has different requirements, different priorities, different goals. So everything has to be tailor made to you. That's what Milestones2Wealth is doing. Everything is you. It's not us. It's you. Everything is all about you. Right. View on semiconductor. Fantastic. Fantastic question. I've done a semiconductor webinar for Sphere on the I thought PMS handle, and it's obviously poised to grow very well. It takes about 20 to 25 million dollars to make a particular fab, and there's a geopolitical war that's going on for semiconductor, and China is the forefront in it. So the users of semiconductor equipment, testing, there are multiple process steps, right? So, and a majority of it, except research and development, up until now, has been with China. China is the largest consumer. They are the only ones who consume semiconductor equipment, the testing, everything is there. The research and development only takes place in US, right? So a lot of so the CHIPS Act has actually committed. They are not yet committed, but it takes about $25 billion to make a plant. So they are committing money there, and they want to come up with more and more plants. Right now, inventory level for semiconductors is very high. Only the most sophisticated ones have done extremely well. Everybody else has not. So wherever there is sophistication, things have done well, but the entire sector has not done well. Right. Now things are changing where China has been able to develop. So whatever roadblock they wanted to put, China overcame it, and they're using older technology to come up with newer nodes and sophisticated nodes. So uh, it's a very interesting scenario to look at when it comes to semiconductors. But there is extremeness, and it trades at it is very exciting. So it's trading at expensive valuations right now. Mutual fund flow is high and retail participation highs. How can we expect fall? How much correction you are expecting in large cap, mid cap, small cap? See, you're participating, we are participating, everybody's participating. So whatever fall of 4-5% or 6-7% is coming is all being bought. It takes 2-3 days. You saw it, what happened right now. So that's why I would always say that, in your personal risk basket, you must have something where you say, yes, I'm going to park something in liquid for whatever comes to me as an opportunity for me to take advantage of. Right. Where there is extreme valuation, high risk of valuation derating is on the small and mid caps. Right. So there the expectation is quite high. So you might as well be safe. Is the good approach of chasing business at pre-IPO? No, not good. View on textile. So we have done one webinar on textile. I think our textile analyst Yash on I Thought PMS has done it. So if you're interested in it, just go to the I Thought PMS page on YouTube, and you can just scroll down, search for it, you would get it. Active fund manager and large caps of most of them have not beaten the index. How do you see that? So I had done a particular webinar for large caps. Why is it that large caps did not outperform? Was it the problem for their skill, or was it an industry specific problem? It was an industry specific problem because there were many changes, many rules that came in, where the concentration was more there than on actual fund management. So there was a lot of churn in the entire industry, right? So that's why you saw active fund managers actually not being able to beat uh, your passive. Passive is backward looking. I would always prefer to go towards active unless and until where is it that active is missing out, there I would complement it with a passive. Right. But that is only from a sectoral perspective or a thematic perspective, not from an active fund manager perspective. Active fund managers do a lot of work. They, the expense ratio for active fund management also is quite reasonable. It's not very high. So you're getting, solid advice. Somebody is working for you day in, day night. Uh, and they have, very large research teams also that are working for you. So it was not a skill specific question. It was more from an industry churn and a change perspective. It had nothing to do with their skill. Where can I watch your video webinars? Yes, it's available on YouTube. Just go to Milestones2Wealth on YouTube and go to the live section. Everything will be there. If I heard you right, Milestones2Wealth is not an advice based. It's a regular mutual. Yes. How do I get financial advice for our personal needs? We have a financial planning arm that does financial planning services. So if you are interested in getting in hand holding in terms of financial planning for your goals, just send us a hi. We will redirect it to financial planning, and financial team will the planning team will get in touch with you. So they work on a retainer based model. So when you get in touch with them, they'll tell you all of it and what's the scope of work that they'll be doing for you. You said 8 to 10 years target for 1 crore corpus. Yes, this is assuming that yes, we grow at a moderate 12% return. What do you think about momentum based? It's backward looking. Momentum based is backward looking because the momentum has already come. So though it has worked, that's why in one of there was a very good question on factor based investing. We are still at a very nascent stage in factor based investing and how it's evolving, how much of a weight they have to put towards alpha or momentum, value, liquidity. That's what matters. So uh, momentum is somewhat backward, but if you add more factors to it, it somewhat works. So that's what we are waiting to see because there are more NFOs, it's back tested. Well, let's see in reality what's happening. Will you be sharing the presentation for reference? No, but you can see it on YouTube. You can see the entire thing on YouTube. I have time for another one or two more questions, and whatever questions you might have, please do put it in the chat box. If you're not on the program, right, just send us a hi here, and somebody from the team will definitely get in touch with you. Right. Uh, if you're interested on the mutual fund side, then Milestones2Wealth is for you. If you do want something, something from a financial advice perspective, then financial planning. We have also done financial planning webinars, but I would say just send us a hi. We redirect it there. Uh, but it's majorly a behavior-oriented program, and we will help you in you being able to save more. Look at how much you can save, increase your savings potential, and help you park your money in the right places. Small case view, in terms of small case, see again, why should you do something like that when you are able to make on a long term basis purely from it's completely regulated, mutual funds are completely regulated. There is high level of work that goes into it, and your cost is also low. The expense ratio is just 1.2, something like that. So if there's a better alternative than that, I'm still able to make somewhere between 12 and 15% on mutual funds. Why do I need to go to something that's not regulated? That's high. Investors only need to look at regulation is high. Yes, they've been able to strive with high regulation. Yes, there's enough support that comes in. Yes, it's legal. Yes, taxation is good. Yes, so then then there should not be any comparison itself with that. Quant mutual fund beating consistent other funds. Your view, uh, see, quant takes a very high risk approach. So, not speaking about the fund, but speaking about the style. It's very open. Very a lot of interviews have also come saying that yes, it's going to be more, momentum based. It's going to be more. They would have some bit of fundamental, but they have a chart that says about their process, and they do take up high risk. So by that logic, I'm running a very high risk, and that's not what Milestones2Wealth is meant to do. It's meant to give you very good return by taking very less risk. So by that logic, I would always look to take less risk. What's your contrarian view in the existing market? Contrarian view is large cap, gold, silver, and debt. Right, I think we've had a fantastic session today. We have overshot uh, the time limit also, and this is one of the longest webinars I've done. So thank you all for joining in on a Saturday afternoon. Do get onto the program. If you're not on the program, just send us a hi. Our team will get in touch with you. We can get tailor-made solutions just for you. Follow us on Instagram, follow us on YouTube, follow us on, I don't know, Twitter also is there. Yeah. So follow us everywhere. You will get a lot more insight. You will get a lot more information. So get on the program if you're not on the program. Like we'll see you again sometime next week. Thank you so much. Have a great weekend ahead. Thank you. Late response from WhatsApp. I'll make sure that you get a response.